underneath the surface, there's some deterioration in the markets, which when you see these types of negative divergences, those aren't immediate like, oh my gosh, the market's going to crash. That's not what that's saying at all. It just says that the internals are a lot weaker than they appear on the surface. And let's talk a little about what you need to know before the bell this morning. So yesterday, the market sold off a bit after coming up and retesting all-time highs. So the good news is that we're certainly sitting here very close to all-time highs, but now we've set a double top right now in the very short term for the S&P. So again, that's not the end of the world or anything like that, because this is right now we're just kind of consolidating in a very narrow channel. So as long as we don't take out that bottom of that channel, which is right at the 20-day moving average, it's okay. We're just kind of consolidating this little recent gain that we had that started back a couple of weeks ago when we broke down on that Friday and Thursday and Friday. So again, market's doing just fine. Bullish trend is still very much in place. But the one thing that I keep kind of coming back and focusing on just kind of as a reminder is that despite the fact that we've got this market kind of traveling higher right now, which is great, we've got a negative divergence in money flows going into the market has been weaker. We've got a negative divergence right now in momentum and a negative divergence in relative strength. So again, underneath the surface, there's some deterioration in the markets, which when you see these types of negative divergences, those aren't immediate like, oh my gosh, the market's going to crash. That's not what that's saying at all. It just says that the internals are a lot weaker than they appear on the surface. And generally, when this occurs, you get a correction in the markets at some point. Again, just the markets are doing fine right now. Nothing to worry about here at the moment, but just pay attention to these negative divergences because they do show up. We've seen these negative divergences before, and when we saw these before, they have always led to, and we've talked about these on the show from time to time, that when they occur, they tend to show up, kind of in corrections in the markets. And we had seen that same type of negative divergence back heading, into February and March. We had this negative divergence relative strength, we had negative divergence momentum, market was doing just fine, and then you had that April correction. So again, these negative divergences show up all the time in the markets, and they're worth paying attention to, not from the fact that it means that immediately you're going to have a correction. That's not what it means. But it's just showing you that there's some weakness in the markets internally, and those tend to show up. Eventually, you get a price correction in the markets because that, again, doesn't mean a huge price, it doesn't mean another April 20% decline, but a 3-5% correction would not be out of the question, particularly given the deviation right now that you have above the 200-day moving average. That's a pretty big deviation. That gap will eventually close. The market will head back towards that. We're at least going to test the 50 at some point, if not the 200-day moving average. So you're going to get some type of correction potentially in the next month or so if those negative divergences don't start to heal up. And right now, they're just not doing that at the moment. And despite that we've had some really good data, maybe NVIDIA's earnings will turn all this around tomorrow and we'll be back off to the races. Very possible. Everybody's very excited about the markets. But again, just from a hedging of a risk, kind of a risk management hedging, position, this is a really good time to think about, just maintaining some cash, putting on some really cheap hedges. And again, if you take a look at volatility as a function, volatility is very depressed right now. So put hedges are very, very cheap. Nobody wants puts right now. Nobody expects a crash in the markets. So again, when you have that type of environment, you can buy cheap insurance on your portfolio at a very low cost. And that, again, it's going to expire hopefully it'll expire worthless because the market's going to keep going up. But that's just in case, right? This market does get a correction, that hedge can come in and help prepare that. And if you're not familiar with the options, it's fine. Just hold some extra cash right now. Do the same thing in your portfolio for the most part. Just help buffer some of that downside volatility if it shows up. Anyway, that's what you need to know before the bell this morning.